What's up, fruitful investors? In this video, I did a webinar with a great real estate investor from Toronto, Monika Jazyk. If you don't know her, she's a fantastic entrepreneur. I'll put her links below to her Facebook page and any other social media links I can find with her. She is a fantastic investor and a great role model, especially towards other women. If you watch the TV show Mothers of Real Estate in the GTA Toronto area, she is one of the people on that show. And I can't say enough about her. She's a fantastic investor and coach towards a lot of people. So in this webinar, I talk specifically about the Kitchener Waterloo market where I personally invest. I share some properties that are on the market currently at the time of shooting that webinar, so you can get a feel about my market, and if you're looking to invest in my area, you can see kind of some examples. I also share some of the properties in my portfolio that I was renovating at the time or that I've done in the past, and I talk a lot about the Kitchener Waterloo market and my strategy of single family investing, duplex conversions, flips, etc. We get into a lot in this webinar, so I hope it brings you a lot of value. It was great talking with Monika, so here comes the webinar.
Today we'll be speaking with KWC's top agent, Matt Piche. Matt is a leading real estate agent in Kitchener, as well as an experienced investor and owner of multiple income properties in the KW area. On today's webinar, Matt will be discussing the proven real estate model he created and has personally used in KWC, giving himself and hundreds of other investors fruitful ROI, even with single family homes. Welcome, Matt, and thank you so much for joining us today.
Thanks for having me.
So let's start off with you telling a bit about your background and sort of how you got into the real estate business, because you've made quite a name for yourself over the past few years of being in real estate.
Yeah, so right after high school, I got into the trades. So my dad was a carpenter, his dad was a carpenter, so I just kind of fell into it. So that's what I did right after high school, and then I started my own business when I completed my apprenticeship, renovating properties only for real estate investors. And the more I renovated for more investors, while I enjoyed that, they all said the same thing. I wish you were a real estate agent. The realtors I'm working with don't know anything about renovations, how to calculate for cash flow, how to add value. You already know how to do all of this. I wish you were my realtor. And I kind of knew that I didn't want to be a carpenter for the rest of my life, you know, backbreaking labor. That wasn't really my ideal lifestyle. So I thought about it, and the switch from becoming a carpenter to a realtor made perfect sense for me. I was still obsessed with real estate investing. It fell in line with what I wanted to do anyway, which was to be a real estate investor, not a carpenter for the rest of my life. So I completed my courses super quick, got my real estate license in about 4 months. I just crammed through the courses. Wow. And then it's been that way ever since. Since 21, 22 years old, I've been a realtor specializing only with real estate investors in Kitchener Waterloo.
That's quite a story. Now, were you raised in Kitchener Waterloo area?
So I was pretty much raised in Kitchener. I was born in North Bay, but we moved down to Kitchener when I was about 5 or 6. So I don't really have any memories of up north too much. It's all been Kitchener Waterloo.
So this really is your area of expertise. I mean, you're 5 years old. You were pretty much raised there. This is really strong familiarity with this area.
Yeah, 100%.
Yeah, and I think being a carpenter really, really kind of helps. You know, it helps people in real estate, especially if you're doing sort of opportunities where you are adding value, like that forced appreciation to the home.
Yeah, definitely.
I think, you know, when we have to outsource these things and find our own contractors, you have contractors walking up the job or overpaying or not doing a great job, it's always really, really stressful for us as an investor, for sure.
Yeah, it's the one benefit I have 100%, because I know when we do a lot of renovations, I know what the properties or what the reno should cost, how much the material should be, what it should look like when it's done, etc. So I know when a contractor is kind of trying to take us for a ride or whatever. So that's a huge benefit that I have.
Excellent, excellent. And so back to this thing. So you finished high school, you're like about what, 17, 18 years old?
Yeah, I was 17.
Right into the trades.
Yeah, right into the trades. And then I became a realtor, like I said, around 22. And then I bought my first rental property at age 22. It was a small condo townhome for $135,000. We rented that out for about 6 months while we still lived at home. And then Rachel and I bought our second property 6 months later, another condo townhome in the same complex. So we lived there for a bit, and then I kind of didn't buy anything for a good 4 or 5 years. I had no more money. I was a carpenter just starting out to be a realtor. I was really young, didn't have any more capital. And that's when I started really working on the social media marketing and online marketing. I know we'll probably be talking about that in a separate webinar. That's a whole thing in itself. But that's really what got my portfolio to grow so quickly, is online marketing, social media, and branding. And I can't wait to talk about that in another webinar maybe.
Oh yeah, we'll do a totally specialized webinar on that, but we definitely, everyone should be following you on social media if they're not already. And we could definitely explore social media as well on this. Let's go back to that. So 22 years old, already an owner of not one, but 2 properties.
Yeah.
What did you learn? Like, did you make any mistakes on those purchases? Now that you know everything you know now, what would you have kind of done differently if you look back?
Yeah, surprisingly, we didn't make any major mistakes. I was already researching real estate investing when I was like 18, 19 years old, totally obsessed with it. So I kind of knew what I was doing. So we bought good properties in good areas. We still own them both today. So they're making us quite a lot of money. But the only mistake I made at the very beginning was the tenant I got the first time. They were a little sketchy. I didn't really know how to like overview tenants or interview tenants. So I got kind of a bad one. He left within 3 to 4 months after moving in, but he paid all of his rent. There was no damage. So luckily it was a good situation. But that was kind of the worst thing so far that's ever happened in our real estate portfolio, was that kind of bad tenant who almost took advantage of us. But I was able to get him out, get a new tenant, and that's when I really started educating myself even more, especially once I started working with other real estate investors and going to RAIN. Then I kind of knew what I was doing a little more. And then ever since then, it's just been mostly single family, super easy, super boring, no headaches, no major things going on. So that's why I like it.
And that's probably why your experience has been pretty uneventful, because I remember, when we started out with single family, it was really easy, and I think you get a different type of tenant quality when you get a single family tenant. And then of course we did all the courses, went way overboard, started doing all different strategies, and got into apartment buildings and multifamily and all these things. And the problems kind of did seem to sort of escalate. So single family really kind of seems to be the way to go. The only problem is the way we do our real estate investment models, and I know we're about to talk about your model, is it really is tough to get a single family home to cash flow, especially in a high growth area like KW. Is it still possible to acquire these types of properties?
Yeah, so we're finding properties every day of the week in Kitchener Waterloo, single families that cash flow. The range is going to be between $100 to $200 a month after property manager. So to some people that might seem that's way too low. There's no way I'm going to do that for $100 measly dollars. You have to wait with single family. It's a long-term strategy. You're not going to get rich off single family today, but you will in 10, 12, 15 years. You're going to be super rich from it if you have a multiple amount of them. And that's the secret with single family. So if you want to quit your job like today, what I always tell people is you probably want to go to multifamily or student properties, etc. But if you can wait, 5, 7 years, buy a bunch of single families in a good area like Kitchener Waterloo, Hamilton, Barrie, etc., and just wait, have patience, because you'll be happy you did.
Well, I totally agree, and that's the message at Real Property Investments that we preach with the buy, rent, hold. Is and $100, $200 is nothing to put your nose up at.
Sure.
Because that's after all the contingencies and all that sort of stuff as well. So technically you are getting more, but you're doing a conservative return, which is always really good. And we always say that buy, rent, hold is a long-term wealth play, and this really should be for bigger ticket items in life, like say your retirement or your kids' education, or maybe if you are looking to leave a job, it can be income replacement for a period of time after you have time to sort of pay down the mortgage and get some equity in that property. I think a mistake a lot of people make in real estate is they call buy, rent, hold real estate investing passive, when it really is an active investment. And it should not, you cannot chase the cash flow and replace your day job with buy, rent, hold real estate. It really is a long-term wealth play. If you are looking to replace your income or create more passive income, there's different strategies that you could use, like say flipping, or you could do rent to owns, or even investing in private market products or private lending. And those are all great. but they don't have the long-term wealth building that single family or even any buy, rent, hold investing really does. And they often end up, unless you're going in different areas, and sometimes the appreciation's not there. But Kitchener is a fantastic area. Can you tell us more, like why Kitchener is a great place?
Yeah, so
how it's evolved over the past few years.
Yeah, Kitchener's one of those towns that's often overlooked. For some reason, it kind of flies under the radar, which is perfect for us. That's kind of what we want. We don't want droves of people coming to Kitchener Waterloo. But one of the biggest reasons is that it's actually a big city. Over 540,000 people live here when combining Waterloo, Cambridge, and Kitchener. So it's actually a big area, lots going on. As many people probably know, we're called the Technology Triangle. So a lot of tech companies are coming here, putting their money into Kitchener Waterloo. You know, the founder of Twitter started a business here. We have Google here. So there's a lot of hype around Kitchener Waterloo for the tech industry. Lots of the universities are, like I said, are expanding their tech programs, attracting more international students. So there's a lot of money coming here. In terms of industries, manufacturing and trade is actually one of our biggest industries. So even though the hype is all talking about the tech industry and the universities, you know, over 30% of our workers are actually in manufacturing or trade of some sort, because we're right along the 401. We're an hour away from Toronto, an hour from Hamilton, an hour from London. So we're in that sweet spot. And that's really the biggest thing for us, is good quality tenants. So the manufacturing and trade industries are more blue collar workers. And there's nothing wrong with blue collar workers. They're my best tenants, but they often tend to be more so tenants than owners. So we have a big tenant pool here, and also a big education sector. So Kitchener is really diverse in terms of industries. So if there's a recession coming, which, you know, we're kind of thinking in the next year or so, there's probably going to be a recession of some sort. You know, Kitchener is a very safe haven for something like that, because we have so many different big industries. And I personally started investing in Kitchener in 2010, which was apparently the biggest depression since the Great Depression, right?
Yeah.
Nothing happened in Kitchener Waterloo. We had some setbacks, but in terms of jobs, tenants paying rent, I never ever had a problem. Kitchener just kind of did its thing through the recession, and that's why I really like parking my money here, because it's very safe with lots of industries.
Yeah, it definitely has a lot of diversity and a lot of those key economic indicators that this is a great place to invest.
Yeah. Sure. Yeah, it's well-rounded. We don't have a one-hit pony kind of industry. Like it could be a car manufacturing industry. That's all that town has. You want to avoid investing in areas like that for long-term, especially for long-term. Like I say to a lot of people, right now we're in a boom economy. We have been for a while. So everybody looks like a genius wherever they're investing in Ontario. Everybody's doing really well. Are they going to do really well in 2-3 years when we're in the next recession? I don't know. But in Kitchener Waterloo, we're kind of protecting ourselves that way.
Absolutely.
The other bonus is appreciation. So because Kitchener just does its thing through the recessions, through everything, it just kind of grows at a slow pace, normally 5% every single year, no matter what. We don't have the big spikes and the big drops like Toronto or Ottawa or other big cities like that. It just kind of does its thing. People just kind of forget about it. But over time, that's really what's gonna make you wealthy. So we're also still a bargain compared to the GTA in terms of house prices. We'll get into that in a bit, but the average single family price that we're still finding every single day of the week is between $340,000 to $370,000. That's the sweet spot for a single family. So you're not gonna find that in Milton, Mississauga, Brampton, etc. So we're still very cheap compared to that. And then transportation. So there's a lot of capital and growth happening in Kitchener, with more trains going to Toronto, right? The light rapid transit is just about finished up in Kitchener. That's also bringing a lot of hype and money to the area. So there's big things happening in Kitchener, which is great for a long-term buy and hold. If you buy now and you wait 10 years as the city continues to grow, it's gonna be pretty good.
This really makes, can you go back to that transport slide? Yep. That really makes a lot of sense. The reason how the GO is like going to all these smaller cities, because, you know, like you said, the housing is just not affordable in Toronto or the GTA anymore. I mean, we're averaging $1 million for a townhouse, and it's just, and that's all surrounding, like anything 1 hour from Toronto. So it's so important that these GO stations, I mean, people, you know, if they want to live in these areas, a lot of these people have to rent, and that's expensive as well. They could buy a place in Kitchener, Waterloo, Cambridge, or any of these surrounding areas and put their money towards an actual home for a less than they would actually even having to be paying for rent here. So I think that's really important. You have a very healthy housing economy, and if a recession does hit, it really probably won't impact because your housing is quite affordable. We're here where we live, say in Markham and outside the GTA, we're the ones that really kind of felt that, you know, the any sort of downturn in the economy, because most people here can't even afford their mortgages, you know, already. So that's great that the transport is so phenomenal, because it's pretty common for people to commute up to 2 hours a day each way.
Insane.
How long is it? How long did you say it was to get to the downtown core?
From the outside or outskirts of Kitchener to the downtown core, maybe 20 minutes, 15 minutes, depending on where you are. And going back to your point, we're already seeing a lot of Toronto buyers moving to Kitchener because the housing is cheaper, and they're commuting, driving every single day, which is like 3 hours, 4 hours per day in total drive time. So once these trains get up and going, you know, every hour on the hour, which right now there's only 2 trains per day, it's really going to be a game changer, because a lot more people from Toronto, from the GTA, are going to start moving to Kitchener, forcing prices up. So that's why you kind of want to get in now before the trend comes in, because over the next 5-10 years, Kitchener is going to look probably very different.
I wouldn't be surprised. I mean, I've seen it happen in Oshawa already when we were used to investing there in homes like under $200,000, and now with the development in North Oshawa, properties are, you know, 800,000 plus.
Crazy.
So it's just amazing. I wouldn't be surprised if Kitchener, you know, was in the $500,000-$600,000 range within 5 years' time.
Definitely, very likely. So we also have a good, strong pool of tenants because there's lots of jobs. It's a very diverse economy. If something does happen in the economy, you know, if the auto industry gets hit really hard, well, we have a big trade depot. We have a big education sector. We have big insurance companies. So there's lots of different industries where if one gets hit, many can pick up the load, which is exactly what we saw with BlackBerry, right? A couple of years ago when BlackBerry went under, everybody thought Kitchener Waterloo was doomed. We were done for. There was no way we could recover. Literally nothing happened when BlackBerry went under. It was just more psychological, and actually even more tech industries bought up their buildings and made more companies. So we're very diverse here. It's super easy to fill properties. When I'm renting my properties or helping clients, it's really 1 to 2 weeks probably before you find a tenant. If your house is well done, it looks nice, you're going to attract tenants very easily, and probably getting bidding wars on a lot of your rentals, which actually happened to a couple of ours, which is insane. We're seeing bidding wars in the rental market, which is really good for us investors.
Mm-hmm.
So
what would you say the actual vacancy rate is now?
Like 1.5, but literally it's 0. If you have a nice property that looks really well, you're going to attract a tenant easily. So I'll go over kind of the properties that we do. So a semi-detached property in Kitchener is my bread and butter. That's what most of my clients buy with my partners as well. We're buying these types all the time, and you can see how renovated we do it. So we always fully renovate a property top to bottom. If you want to see the videos, you can go to my YouTube channel. I have a video of every single before and after renovation we've ever done. So if you want to see more than just pictures, head over there and check them out. But like I said, this is the bread and butter. This is what we buy all the time. Price range between $340 for one that needs some work to $370 for one that's kind of turnkey.
This is really nice. It's done really well. It looks very clean. Would you say this is more of a high-end reno, or is it more middle of the range reno?
This would be slightly above middle of the range, but not fully high. So maybe the middle between mid and high level. And that's kind of what we do. We have a system. We use the same flooring, the same paint, the same baseboards over and over again. And it's proven. We get the tenants every single time. We get the rents that we want. So we just go through and do it over and over again. And it's working really well.
So it looks like, I love the modern appeal with, you know, the cabinetry. You went an extra step with the stainless steel appliances, which is great.
Definitely.
Do you go to the extent where you do like a granite or a quartz, or are you still using just the nice normal countertops?
So we use a nice normal laminate countertop. We usually never do a quartz in a rental just because they can stain quite easily and it's quite costly to fix them or if they break the countertop. So, but what we do is we use a flat countertop. So if you can see in the corner against the backsplash, there's no backsplash on the counter. We're bringing the tiles right down. So it gives the effect that it's a quartz countertop looking style. So that adds a little bit more. It costs a little bit extra, but it's totally worth it. It really makes it feel higher end.
And so when you rent out units that look like this, and I love the fact that you have a reno system. We have for our apartment buildings, we totally do that. It's just like, you know, carbon copy for every unit. Yeah. And it makes it a lot easier. What sort of tenants would you say this attracts? Is this for your, you know, working class tenant, like a really great person? Yeah. They're more like into the trades or working class? Or is this something like, are you going to get like a millennial couple lawyer that's kind of commuting to Toronto every day?
So slightly both, but with these styles for the single families, it's usually a blue collar family. Maybe the husband's in blue collar work, the wife's in white collar work. They're making between, you know, $50,000 to $70,000 a year for their job. That's kind of the ideal tenant that we're going for these. We do have a couple of duplexes, which I'll show in a second, where they're much higher end, more downtown, and those are geared more towards millennials, lawyer types, and we go a little higher end on those rentals as well. But for these single families, it's kind of for your everyday Joe, nice family, 2 kids, dog, cat. We want the whole thing because then they stay for a long time.
So how long do you normally find these tenants staying? Like, because I remember when we started out in real estate investing, our avatar really was like the working class tenant that just never would have a hope in hell of being a homeowner. So they're a lifelong renter and hopefully they stay forever and ever. With this person, if they both have, say, $50,000 a year, is that their total family income, or is that kind of what they make?
That's per person usually, so 50,000 per person. So these tenants stay usually between 3 to 5 years. That's what we're seeing all the time. And on these semis, we have a bunch of them, and some of the tenants have been there for 6 years. The first tenant we ever got on them, and they're still there. So they tend to stay long term.
Do they have the inclination to become homeowners? So like while they're renting from you, they're kind of building up their credit or saving those down payments so they actually buy something in the area? Yeah,
so a lot of them say they want to be homeowners, now that I think of it, but we really haven't had anybody leave to become homeowners. They kind of stay, or they maybe find another rental property. Maybe they had a kid, they need more room, but they're still renting. So we haven't really seen a tenant turnover to buy something yet.
Interesting. Well, this looks great. Fabulous. Show us the high-end downtown one.
Well, I'll go over the numbers first on this single family, just so you know what to expect if you buy something in Kitchener. So we bought this property 1.5 years ago for $185,000. We put in $37,000 in renovations, you know, with holding costs and closing costs. Renovation $30,000. Our all-in cost was $73,000 to buy it. That's to 20% down, and to renovate. It is now worth today, 1.5 years later, $360,000. So we did have a big spike in the past couple of years. This is not going to be typical for the next 2 years in terms of growth, but it's still a lot of growth. Our total profit so far is $150,000 in just 2 years from forced equity and depreciation. So that's kind of what we're seeing in the area. Our monthly costs, if we switch over to the monthly financials, you know, our mortgage payment is $885, property taxes, insurance, our property manager of $82.50. Yes, we always get a property manager for all of our properties just so we can live our life while the business does this thing in the background. Currently, the rent is $1,700. So we're cash flowing on this single family for $483. So this is what I'm saying. Because when we first bought the property, people were saying, you're only buying this property for $100 cash flow? Yeah. That's so stupid. Wait long term with single family. The rents go up faster than multifamily. The appreciation goes up faster. So now in year 2, we're up to 400. Again, that's not typical for the next 2 years likely, but it's probably about $100 a year in terms of rental increase in a normal market. So if you wait 5 years, 6 years, 10 years, that's when single family really becomes attractive, because one tenant, super high quality, they pay their rent every single month, and we're getting that $400 every single month.
And I cannot believe you bought this for $185,000.
Yeah,
like
it's a little unrealistic.
Like, why didn't I buy this? Jeez.
Yeah, we bought this right before the big spike kind of happened. So again, it's not typical, but it's fairly typical of what's gonna happen in the long term.
Well, if anyone watching this has any questions about Matt's properties and the numbers, definitely type it in the question box. I will be monitoring the question box, because I'm sure people will have, because I didn't even know you could get this for $185,000, and that is just phenomenal increase in value. And, with that hold, just the hold for 5 years, it always takes 5 years at
Only
least.
5, yeah. Sure.
You're usually looking at that 30% ROI. I mean, just by paying down the mortgage every month and renting out the property. I mean, when I did the numbers on a $375,000 property, appreciating at 5% over 5 years.
Yeah.
And the rental was only a few $100 a month, maybe a couple $100 cash flow. It only equated to $20,000 over the 5 years.
Yeah, exactly.
Into the $110,000, of the actual natural appreciation of the property, it turns out to be like over a 30% ROI.
Yeah.
And the amount of money you could pull out, is about, $130,000. And this could be, used for multiple things, such as to send your kids to school, or even if you take a property like this and do nothing but pay off the mortgage for 25 years, this property at 5% increase would be, not this one with the 180, but one at in the 360 mark is going to be $1.25 million.
Yeah, it's crazy.
So people out there don't even need like 10 of these. Even one property like this is a huge, spike to your wealth plan for sure.
Yeah, one single family like this for 10, 15 years, it'll completely change your life financially. Absolutely. So we'll switch over to the duplex right downtown that we bought. This property was pretty much a new build. When we bought it, it was gutted right down to the studs, and we converted this big single family home downtown to a duplex. So we redid everything pretty high end for a multifamily. Right downtown Kitchener, 300 meters from the light rapid transit station before it's up and running. So we got in there before it's gonna be up and running. And this one was a pretty good investment. This is the higher end that we're talking about. So the tenants in here are millennials. It was the exact tenant avatar we were looking for. And I think it turned out pretty good.
Who chose that navy blue wall?
That was Rachel for the feature wall.
I love it. I've never seen a navy blue wall. That makes such a huge impact. You can see where you have the same, main colors, the same flooring, the same, big trim.
Yeah.
And then that wall just makes it pop. And what is that counter? Is that counter still like a laminate countertop, or is that a bit more?
Same one, and then we did a breakfast bar in each kitchen. So if you see in the fourth picture on the bottom here, we always do a countertop hangover for like a breakfast bar. And that's what we started doing recently. So this renovation is more of our recent color scheme. And that's what we're trying to do in every property, is get that breakfast bar. People really like that.
Because it's a nice open concept, totally. It really kind of opens up the room. Yeah. So you actually have a question here that I'm gonna read out, sorry to interrupt. It's, hey Matt, I love the single family rentals. I own 2 in London that meet the 1% and was able to BRR the first one and will be refinancing the second one in the next couple of months. Excellent tenants that haven't caused any issues. I've been in Brazil the last 3 months and the only messages from them have had email money transfers.
Nice.
I love that.
Exactly.
Love the more hands off with single family. If you renovate properly, nothing big breaks. First property purchased for 100K, 20K reno, rents now for 129.5 plus. Second property, 135K purchase, 30K reno, rents for 160 plus, has been a huge impact on my financial life. Yeah. So thank you so much for sharing that, because, I totally agree. This model can, even just 1 or 2 properties will change your entire wealth plan. And then we need your address in Brazil, because we're all going to come and see you.
Definitely.
Everyone on this webinar is going to come see you in Brazil. We have one more question. It says, hi Matt, I didn't see a monthly cost for down payment, reno, loan interest factored in. Do most of your investors you work with buy with cash?
So most of them buy with cash. The one that we just checked out, this one was a mortgage on it, but we did it in 1 month turnaround. So we had the holding costs here for $3,000. So it wasn't too long. However, like this one, the duplex, where we had to like pretty much rebuild it, most of my partners buy properties all cash. So there's no mortgage, there's really no cost except for utilities and property tax. So that's kind of the way we do when we do a big flip. However, I still have partners that bring mortgages to buy these properties, and they still work out very well. And we include those costs in the project fund.
But after they buy this cash, don't they go in for a mortgage?
Yes, so we always get a mortgage after, I should say that. So every time when we're done, we get an appraisal at the higher value, we get a mortgage set at the highest value we can, and then I pay my partner back all of his money, hopefully all of his money.
And so when you do that, how easy is it for you to create an infinite return? Meaning I'm able to give you cash to purchase the property and get the reno, and then get a mortgage for the property where I actually get all of my capital back, and I'm still making monthly cash flow even though I have no cash in the investment.
Yeah, so today in this market, you can't really do that with a single family. We'll really never find a single family that low where we can jack it up that much. However, where we can do that still is with duplex conversions, which is what we're doing a lot more. And it's what we did with this property here. This was a duplex conversion. So there we can almost always get all or most of the partner's money back. So that's
even if you get some of it back. Like let's pretend I give you, you know, $300,000 for this, and we up this property to $400,000, and then I get a mortgage after for 80% of that amount. Maybe you have like $10,000 or $15,000 in, but if you divide that number, you know, over your initial ROI, this is where your cash on cash return just absolutely skyrockets.
Yeah, so duplex conversions is where you really want to do this if you want to get your money back. Single families won't really work. It's just more of a good long-term buy and hold. But if we go over the numbers here for the duplex I'm talking about, this is where my partner got almost all his money back. I think he's only into this deal for about $6,000 when we're all done. So we bought it for $328. It was a private deal from another investor that I know. He just wanted to unload it and move on to something else. So we bought it all cash. Holding costs took 2 months of renovation, so $6,000. Renovations were $110,000. So it's a major renovation to convert these. So our all-in cost was pretty much $450. We got it appraised 2 months later for $565. So with the new mortgage, my partner, like I said, was in for about $6,000 or $10,000 into the deal, and the equity we made in 2 months was $115,000.
From the forced appreciation. And I think that if you weren't a contractor, you don't have that building system. It's not that. You might be half of that. I think you really have that competitive edge. Now, this price, $328, is huge difference. And I know the market's gone up and whatever. And this was a disaster house, you said?
Disaster house, yeah. It was a big detached house right downtown, and it pretty much needed to be bulldozed or rebuilt. We chose the rebuilt route.
Well, once you always choose the rebuild route, even if you keep the one existing wall, you avoid your development charges.
Exactly, yes.
$1,000 savings, so why not? So is the downtown core that desirable in Kitchener, you know, opposed to the outskirts?
Yeah, so I always say if you want to do multifamily, you're going to want to do it in the downtown core. Don't really ever buy single family downtown. It's the wrong tenant profile. Those tenants don't want to live down there. It's too busy, too much traffic. But the millennials or the multifamily tenants, that's where you want to do it. If you want to do single family, we do it on the outskirts, so far away from the LRT. So even though the LRT has a lot of hype and buzz around it, if you're doing single family, you want to be as far away from the LRT as possible. And that's where that tenant profile really does really well. So it depends which strategy you want to do and where you'll be buying. That's what I can help people with when they tell me they want to invest in Kitchener.
Well, that's the beauty. And at our, you know, all of our agents like yourself that we work with, we say our agents, they live in the area, they work in the area, and they invest in the area, because people do not know, you know, the difference. Like it's these little things is what helps give you a competitive edge. You know your tenant profile, you know who wants to live where, you know what happens on Saturday night at 3 a.m. and you also know what happens on Sunday afternoons at 3 p.m. in each one of these types of areas. So I think it's like that familiarity with the area is so important for people who live in Toronto like me, and they want to grow their money, but we don't know, you know, we just don't know the street by street breakdown in these areas. So
yeah, it's the same for me. If I go to Toronto or if I go to London or even Guelph, which is 25 minutes away from Kitchener, I have no idea what I'm doing, where to buy, etc. So really work with experts in specific areas.
And focus in areas too. I think when people have their portfolio so scattered, it really does tend to become a bit of a nightmare.
Yeah, that's one thing I'm kind of against, is buying over here, buying over there, buying 3 hours over there. That's not really the style I preach or talk about. Just focus on one area. Like I say all the time, I only do Kitchener. I don't even buy in Guelph, which is 20 minutes away. Doesn't interest me. Kitchener, Waterloo, Cambridge only.
And that's so funny, because I'm sure, like, you know, you and I were kind of on the real estate scene, and you're surrounded by people that have multiple like properties, and they're so everywhere.
Yeah.
And it's kind of like, you kind of remind me of us in the sense that we're sort of the boring
Yeah, for
real
sure.
estate people. We
I
have
like
tons
that.
of properties. We're obviously doing this full time.
Yeah.
But well, you're sort of like, well, I just only do this in this one area. And then Vaughn and I are always saying, you know, even if you have one property, you're farther ahead of the game.
For sure.
I guess it kind of makes us the less exciting bunch.
Yeah. Oh, well, I like my business to be boring and I have fun in my life. We go to Hawaii, we go to Bali. That's what we do with the money from real estate.
Absolutely. Like, you don't always want to be on the hunt searching
Yes.
for income properties. Why aren't you out there? You know, I always say, you know, I'd rather be on the tennis court at this point rather than be hunting for real estate all the time. So I think that's the secret that a lot of people miss, is if you're addicted to the hunt and to the chase and to becoming an expert on anything, everything, like what are you truly hiding from?
Yeah.
Because if you're doing real estate right,
Yeah.
you know, it doesn't take much to be very, very impactful and give you that freedom so you could live the life of your dreams. Because chasing properties all day long, it's not a life, that's a job.
Yeah, 100%. And like I even know a couple of investors that I meet all across Canada or in the States, and they're absolutely killing it, but they're stuck in their town all year long. Even though they're making so much money from their business, they're still hustling harder than everybody else who just works a regular job. It makes no sense. There's some, like you said, there's something else going on. You really want to have your life be fun from real estate. You know, don't be so obsessed with the business itself. That's not for me. But again, everybody has their own system or their own way of life. I really preach, you know, boring real estate and have fun in your life because of real estate.
Absolutely. I couldn't agree with you more. Usually when something's exciting in real estate, it's because something's going wrong.
Yep, 100%.
Excellent.
So here's another property. We'll go through one more. This is a property we're closing on in a week, actually. So it's 3 townhomes and a detached home on one lot. Again, right downtown Kitchener. And we're actually 300 meters away from this GO station in Kitchener. So we're getting in before. So the LRT's there, the GO station to Toronto's there. So this was like a grand slam to me in terms of deals. I'm really excited for this one. But it's a problem property. All the tenants in here are super low quality. We got some empty. Some of them are refusing to leave, so we'll be dealing with that. But this is what I avoid, right? So this is why we don't do multifamily. So we're gonna get them out. We're gonna renovate all the units completely, top to bottom, and get that young millennial Google tenant, right? This is 500 meters from the Google headquarters in Kitchener. So it can't be better in terms of location. And the numbers on this one look really interesting. You know, we bought it for $730, even though it was kind of a crap hole. That's what we paid for all 4 properties. Again, all cash. My partners brought all the money to buy it all out, no mortgage, holding costs in terms of utilities and just other holding costs, budgeting around $8,000. So renovations are $200,000 for all 4 properties. So like I said, we're going pretty all out. We're doing everything all over again. So the all-in purchase cost for this whole project is $950,000. 2 months is what's going to take for this renovation. Contractors are already lined up. We're going to try and get it appraised for $1.3 million, and we're very confident that the cap rate really suggests that price for what we're going to get in terms of income coming up. This will be a commercial mortgage, so it's very different from residential, where it's all about numbers. Numbers dictate value. So that's why we're very confident in the $1.3 million. So the total equity we're going to make in this project in 2 months is $325,000.
Wow.
This property was on the market for over a year, and everybody overlooked it, thought it was a piece of crap. And this happens all the time, especially in multifamily, which is something I'm getting more so into, is flipping multifamily and getting high quality tenants. That's an avenue a lot of investors don't want to go down, but that's where you make bigger money, like way bigger money.
That's incredible. And you think that renovation is $200,000. That's not a lot.
Yeah.
Okay. Can you go back to that slide again? I want to have a look at this again.
This property, yeah.
This is interesting because this is the single family house over here, right?
Yeah.
So where is that situated? Is that like behind it, like a different street?
It's on the same lot. So it's just right beside it. This where the van is a driveway for that specific house. The parking spots for the townhomes are right here, right beside the van. So this is a detached house, and this is 3 townhomes.
That's too bad that you can't separate it and separate the parcels. Now, have you ever thought of actually, and I've done this before, I had a similar a project like this in Oshawa, which was a couple of multifamilies and some single families. And we redid it. It was an L-shaped lot. And we actually created stacked townhomes all through it. So it ended up going in a big L shape, and you could probably create like even 4 more units if you got rid of that house.
Yeah, so the lot ends right after the house, so it's pretty tight because we asked if we could develop it, if we could do something. The city kind of said no with the zoning. And Kitchener zoning is pretty picky with stuff like that. However, a big developer actually bought I think it's 5 lots right beside it, going all the way down the street, and they're building 102 units. So they're gonna be all brand new, mostly townhomes. So this is gonna just jack up our area again in the next 2 or 3 years. So we're really getting in before all of this is going on, which is kind of cool that that's even happening.
I love that. I love this, and I like how you're familiar with the town, with the zoning. Most of our agents are in like City Hall all the time.
Yeah.
You have to know this stuff because a Mickey Mouse like person from Markham say, you know, like me, oh, this looks great. Oh, I could do this. And then you tie up your money in that, and you can't go forward, and you're stuck with all these problems. There's one more question. Sorry, I'm just gonna read out really quickly here. I always assume most people getting into real estate would fund their down payment reno using a HELOC from their principal residence, leaving them with HELOC interest to pay monthly, eating into cash flow. Yeah. Where do your investors using cash get it from?
So 99% of the time, it is a HELOC. So they're going to use it, and then we'll pay them out when we do the refinance. And we do include those fees. This is where the $8,000, for example, on this one comes from. This is from the HELOC fees. So we do pay for those. But I do want to, if investors feel discouraged from buying properties because it then won't technically cash flow with a HELOC, just think of it of if you partner with someone, you're giving up 50%, or if it's barely cash flow because of your HELOC fund, but you own 100% of it, you know, you should really think hard about if you want to actually do that or run away. A lot of investors say, I won't buy property because it won't cash flow, you know, $1,000 or just cash flow $50 because of my HELOC. Again, long-term, think long-term. It will be worth it if you buy a good property, especially a single family at that point where it's boring, consistent, less risk if you're only cash flowing $50, $100. So I would always urge people to use your HELOC as much as you can. Get into properties, use that money, and multiply your incomes.
Well, in a case like this, I mean, it sounds like, how many investors did you have on this property?
This one is 2 others and me.
Perfect. Okay, because I'm pretty simple.
Yeah.
So I know there's some people out there and they're like, oh, well, you could just get like 15 people together and buy $1 million property. And I always say, why don't you just find one? Like, just find the right person. So it sounds very clean. Yeah. And those people, yes, they may be loaning their cash, but with this $325,000 that they're going to be getting back, well, they're going to be able to repay whatever their cost of borrowing in there anyways. So who cares about the monthly cash flow? I mean, it really is kind of the long-term game for sure. Can people ever do their registered funds with you as well?
That's something I haven't really got into. I could definitely talk about it with specific people. Usually I have one partner per property. This is the only one so far where I've had 2. It's usually just one person every time, but it's something I'm definitely open to, especially as we start doing these bigger multifamily flips. We also just buy, 3 townhomes, same kind of setup in Cambridge. So we're doing that. So I really like the idea of flipping multifamily long-term.
And so when you have I guess you're doing these as joint venture partners.
Yeah.
And they're the equity partner and you're the sweat equity partner.
Exactly. Yeah.
I know, do you normally do things like say 50-50 or how does that work?
So at this point, I don't put any money into any of my deals, really. I have so many partners coming on to provide all the money. What I do is provide the system. So I have the contractors that pretty much work for me all year round, which is why we kill these properties in 2 months or 1 month in renovations. I have the whole system. I know how to find tenants. I have the property managers, and I run the whole business for as long as we're partners. So 3 years, 5 years, 7 years. I do everything while they sit back and learn from me if they want, which is kind of how my program is set up. It's more of an apprenticeship program. So if you work with me, I'm going to teach you why we're doing it this way. Why are we using these color schemes? Why are we marketing in the ads this way to get this tenant? I teach you all of that.
And then you have boring people like me who are like, I just want to grow my money.
Yeah, actually almost all my partners come on board with that mentality of, I want to learn from you, I want to learn from you. But once I get into it and once the property's set, I don't really hear from them too often. They're very happy with just laying back.
And you know, like when we do this as a business, I'm the same way for joint. If we do joint ventures, you know, you shouldn't have to put your own money into the deal. Our expertise obviously speaks volumes. The acquisition, the systems, the management. You're definitely holding your part. What I meant was on the any refinance component or sale or monthly cash flow that does come in. Is that something you normally split, say like 50-50?
Yeah, so all profits are split 50-50. However, the way we have it set up for all of our properties so far is all the cash flow goes right back into the property's bank account every month. We're not going to draw from it like the other single families. We're making $150. We're not going to split $75 a month. That's useless. So all the money goes back in so that if a tenant leaves or if something breaks, we have the money there. I don't have to go back to my partner and say, okay, we need more money. We have the money there. We're paying for it every single month. So we have a big party at the end. So we stack all the money, and in 5 years when we sell, then we split everything 50-50, cash flow, appreciation, and mortgage pay down.
Well, that is like an administrative nightmare if you guys are doling out $50 a month to split. But if you use it to set it aside, obviously you already have your maintenance and repairs, you have your vacancy rate, you have your property management, all that stuff set aside. But if you take that money and do your mortgage, your extra mortgage payments, it's amazing how mortgage pay down that can really help accelerate that. Even though normally, you know, with real estate investments, people are just doing this on their own. It's not really worth accelerating your mortgage and paying it down faster. But in this case with JVs, rather than, you know, doing, you know, little portions, it really can make a huge difference. At the end of the year, you take that money, or, you know, even every quarter you kind of make that extra payment.
Yeah, exactly.
And when you pull that cash flow from the property, it's just so much more.
Yeah.
This is really nice.
So here's a property on the market right now. So I'm just going to show some of the people here what's really on the market today. I've showed you some past examples. You're probably like, oh, that's too good. I can't get it anymore. I'll show you what's on the market now. So here's a little townhome. I have one actually on this street, just like this. It does really well. I'll try and share the numbers here. Trying to find how to share the numbers on this one. Okay, there we go. Can you see the numbers now?
Yes, 565 Parkview.
Yep. So there's a property on the market right now for $294, right? 20% down payment, $58,000, renovation cost estimated $15,000, which is kind of typical for a townhome this size. Closing costs, land transfer fees, all in, and a sleep at night fund. If the people don't know what that means, whenever we buy property with my partners and my clients, I always advise that we take 1 month's rent and we put it in the property's bank account on day one. So we have that money there in case there's repairs in the future. We're already building that sleep at night fund. So that's what that is, if you don't know what that means. So our total investment on this property is $80,000 to buy, with a mortgage payment of just over $1,000. This is calculated with a 3.5 mortgage rate over 30 years, which is what we're still getting right now, typically for investors, 20% down. Property taxes, our insurance, again, property manager, this is all taken care of. Our total expenses are $1,374 a month, but the rent is $1,750. So we're cash flowing $375 on day one. So this is a real property that's on the market right now. I've already sent it out to all my clients, but this is a real example of what I can find you on a regular basis.
And that's plus utilities, right?
That's plus utilities. So the tenant pays everything.
I like that. I like that. I cannot believe that this is such a phenomenal price, and it's in such a great area as well.
Yeah. So
and this is a freehold townhome. So
that was a freehold townhome, yeah.
Like unlike your first condo town, I guess, you know,
exactly.
The disaster of condo fees.
Yeah.
Excellent. No, I love that. I love that.
Trying to share back to the property there. So here's another one on the market. This is a semi-detached. This is what we buy all the time. So here's an example of that. So good part of Cambridge.
We're still on the Parkview slide.
Oh, it's on the Parkview?
Yeah. Let's switch it back.
Different?
Nope.
You
gotta love technology.
Yeah.
When it works, it's good. But it's amazing the fact that even like under $300,000 that properties are still available. I mean, you wouldn't get this in Barrie. You're not going to get this in St. Catharines.
Yeah.
Oh, this is a nice house.
Yeah, so this is the semi-detached that we buy over and over again. Literally my favorite property of all investment types. So good area of Cambridge. I'll go over the numbers on this one. So this one's 39 Mill Creek. It's currently on the market. Again, 349. So again, we're right in that sweet spot of 340, 370. This is a very typical semi-detached single family. I can find you almost any day of the week in Kitchener. Renovations, there's no pictures on this one, so usually means we're in it for a little more. So 15,000 could be 20,000, give or take. So all in, we're around the 90,000, which is what I always tell my clients. So 80 to 100,000 is what we're going to be in for a typical semi-detached single family, all in after renovations and everything.
So there's like a $50,000 price difference between a town and a semi, basically.
Yeah, definitely. Yeah.
And does that kind of go up for a house too? So if you're a house for more 400?
Yeah, so the houses will be 450, 400. Those don't really work for investment purposes. A detached house will not cash flow in Kitchener. It has to be a semi or a townhome typically. So the properties we're just doing.
Which is great because the taxes are so much lower.
Yes, they're much lower. Yeah.
Do you have high taxes, would you say, in Kitchener?
I don't think so.
In taxes in Kitchener, Waterloo, Cambridge?
They're all the same throughout. So Waterloo, we don't invest in at all because of the rental license. So it's only Kitchener and Cambridge. But the taxes are the exact same, really, between both cities. So like here on a semi, 214 a month, that's typical. So between 200 and 220 a month, that's kind of the average property taxes for a semi.
That's very low, yeah.
Yeah, so our monthly expenses are 1628, the rent is 1750, and the cash flow is 121. So a lot of people would say, Matt, this is a shit property. I'm not going to invest in a property that makes $100. Wait, I showed you the example of what happened to our Elgin property over time. That's going to happen again for sure. So wait a couple of years. But what's different between this and the townhome is the tenant quality. The tenant quality in the semi-detached is going to be much higher. Probably an upper blue collar workers or white collar workers. They're going to stay much longer than a townhouse. A townhouse is definitely a step up for most people before they buy. So these tenants will stay for 3, 4, 5 years on average.
Excellent, excellent. I like that. I don't find that 121 boring. I think this looks fantastic. Yeah. Excellent.
Should we show more or running out of time?
Sure, show more. We got, anyone else any questions? Make sure you type your questions in.
Are you back on the screen with the house?
Yeah. I really like this house. What is your rule of thumb in regards? Are all these like 3-bedroom, 1-bathroom, 3-bedroom, 2-bathroom, yard stipulations? What's your criteria?
Yeah. So our single families, you always want 3 bedrooms minimum. So never a 2-bedroom really for a single family, but there's an abundant amount of 3 bedrooms, and it's usually 1 bathroom, which a lot of people freak out and say, there's only 1 bathroom all the way upstairs. It works for us all the time. It hasn't been an issue. If you can fit a 2nd bathroom in the basement or on the main floor, that's just a huge bonus. But you'll get almost the same rent anyway between a 2-bath or 1-bath. Yeah. That's kind of the formula we're doing.
We had someone raise their hand. And if you're raising your hand, you can type your question in the chat box or the question box, and we will get to you.
So here's an example of a newer duplex on the market right now. Is it showing on your screen?
Mm-hmm.
Okay, so here's the picture. So we can see fairly turnkey.
Ooh.
So this is the exact property. It's in a great area, actually right in the Fairview Mall area, which is where the main LRT station will be. So you're 5 minutes to the mall, 5 minutes to the LRT, all grocery stores, schools. So super high-end area, especially for multifamily here.
Excellent.
You see, really well done. And we'll go back to the numbers on this one.
So once you get in there, like with that one, and you kind of like update the backsplash and kind of like paint the cupboards.
Yeah, you could definitely even still add more value for sure.
Yeah, so then you get that less tired.
Yeah, definitely. So price on the market right now is $512,800. That's kind of typical for a newer duplex. That's actually a pretty good price, actually, even at that price.
Well, if you break it down per door, then you're still, less like in that $250 range, which is incredible.
Yeah. So down payment, $102,000. Renovations, really zero. It doesn't need anything. You could improve more, but it'll rent just fine as is. Closing costs, land transfer tax. So all in, $114,000. With our monthly costs, all the expenses, all utilities are split, which is a huge bonus for a duplex. Normally, we pay gas and water and split hydros. Because this is a newer built one, everything is split. So it's really like owning 2 single-family properties. So all of our expenses, $2,355 a month. Our rent is $2,700 a month. Cash flow 344 on day one. So again, that's pretty good.
That's really good cash flow.
Yeah.
That's really good cash flow. And all the cash flow really kind of, you know, it stays pretty steady throughout. I mean, I'm sure if this is a 4-unit, then you'd be up to almost, you know, like almost 1,000. So it really kind of, it blends, it sort of breaks down really nicely.
Yeah, exactly.
Mm-hmm. Excellent, excellent.
So we're kind of wrapped up. For me, I can show you a lot more privately if anybody's interested, but you can get a lot of my books or courses through my website. Just go to my YouTube channel or Instagram. I have a bunch of courses and 3 books, my podcast. So feel free to look at that. How I can help you, there's 2 ways. So I can help you either as a real estate agent in Kitchener, where I just help you find the property and then kind of set you up on the system. Or the second way, like I said, is where you partner with me in my apprenticeship style program, where I do everything for us while teaching you, while doing properties that I've showed you just earlier.
I think that's a very, very valuable program. And this is where they can find you on YouTube?
Yeah, so you can find me on YouTube at The Fruitful Investor or on Instagram at Matt Piche. So YouTube is where I put all of my strategies and tips, etc. Instagram is more for my personal day-to-day life. So if you want to follow me with what I'm doing every day, what I'm promoting, etc., what I'm doing with my clients, my partners, that's more of a personal avenue. So I would say subscribe to both, please.
Excellent. No, social media is all the way to go this day and age because it's really important. It allows people to really know who they're dealing with, and they get to know, you know, the person who is behind these investments or behind the coaching or behind the advice. And I think it's a great way for people to really authentically get to know you if you're doing it the right way.
100%.
And I think you're probably the most authentic person.
Oh, thank you.
I know. I met you about 5 years ago. And, you know, really what you see is what you get. And there's nothing that makes me happier than seeing genuine, authentic people being successful by being themselves.
Yeah. Awesome. Thank you.
You're very normal, Matt.
Thank you.
Interesting.
Yeah.
But very, very genuine and very normal. And we have one last comment before we go. He says, no questions. Great show. See you at OREC in London. Met you there last year. So I don't know if he met you there last year or me there, or maybe we both met him there.
Likely both,
I don't know about you, but I love meeting new people and just kind of just sharing a story, and more importantly, listening to other people and seeing what they're up to and seeing how we could help. Just like your YouTube channel is all about helping people.
Yeah, 100%.
And sharing your strategies with that abundance mindset, not a scarcity mode, always selling. I think that's fantastic. So anyone who was watching, or if you're watching the replay, we will be sending the replay out as well. You can touch base. I'd encourage you to follow Matt on YouTube, on Instagram, on any way you can follow him, reach out to Matt. And if you want to reach out to us, just shoot us an email at info@rpinvestments.ca, and we are more than happy to make the connection. So thank you so much for your time, Matt. This was a lot of fun. I can't wait to hop on this webinar with you again, and we're going to delve into a totally different topic, all about your amazing social media channels.
Awesome.
Can't wait for that. Yeah. And to everyone else out there watching, join us next Thursday at 12 p.m. Eastern Standard Time for your next lunchtime wealth webinar series. Monika Jazyk, Real Property Investments. Have a fantastic day, everyone.